A lot of the institutions that were not involved do share my view that it was egregiously overvalued. It's only off by a third. My $150 price target is where I would be an aggressive buyer of the stock.
Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in this video, I'm going to be reacting to Tesla's most bullish bear, Craig Irwin, who currently believes Tesla's stock is about 4 times higher than it should be, yet in the same breath, he's happy to say that he loves Tesla, the company's executing well, they've got great product roadmap, they're going to sell huge numbers of units of their new products and more. So let's get into the video. But first, hey guys, if you'd like to help out the channel and get up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. Unless you don't like free stocks, that is. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Let's get back to it.
Let's bring in Craig Irwin from Roth Capital. He's got a neutral rating of $150 price target on the stock. As we said, it's down at 11% on the week. It's down 3.5% today. It had been down 10% on just the day earlier in the session, so it's bounced like others. Craig, good to see you. Thanks so much for joining us. The institutional investors that you speak to who maybe were reticent to buy Tesla at its peak valuations in recent weeks and months, do you think they're going to be drawn in now we're at $600?
So a lot of the institutions that were not involved do share my view that it was egregiously overvalued. It's only off by a third. My $150 price target is where I would be an aggressive buyer of the stock.
Craig Irwin is just such a strange character. He's such a walking contradiction between Tesla bull and Tesla bear. So for those of you that don't know, Craig Irwin has been covering Tesla stock now for well over half a decade. He has a reasonable understanding of the company and the industry, and in truth, he makes a lot of fair, valid and reasonable points about the company, their products, their execution, etc. Yet still, the price target to me just absolutely nonsensical. In fact, let's see what Craig Irwin has had to say about Tesla stock over the past few years on tipranks.com. Here we are looking at Craig Irwin's profile on tipranks.com. I know a few of you are hoping to see Gordon Johnson's 1/4,000th of a star rating, but that joke's getting a little bit old now. Craig Irwin, as an analyst, has a pretty good track record. Look at this, ranked 549 out of 7,334 analysts. Lots of rating on lots of stocks. So let's see, what does he have to say about Tesla stock in particular? Okay, so a $150 price target on Tesla stock, suggesting about 75% downside from here. Let's see the history of Craig's ratings on Tesla stock. So, Craig Irwin initiating on Tesla stock in 2013 with hold ratings, then quickly deciding, you know what, Tesla stock is a buy at these levels, buy in 2013, 2014, fantastic. Then, interestingly enough, we have a gigantic gap. A 5-year gap with no further ratings on Tesla stock during this entire period. Interesting. Then, now this is a thing that really confuses me. Craig Irwin resumes coverage on Tesla stock with a hold rating at the same levels he was saying buy 5 years ago, half a decade ago. The stock that he thought was a great buy half a decade ago, now, 5 years later, after incredible execution, winning every award ever, accelerating the technological lead, and completely embarrassing the so-called competition, etc. The same levels, even lower in some cases, the stock's just a hold. This is the thing that I do not understand. Please, somebody in the comments, if you have any ideas why this would make sense, let me know. So, half a decade later, Craig's saying, yeah, don't buy the stock now, just hold on to it, hold. One buy there when Tesla stock fell off a cliff. This is when I sold a bunch of stocks to buy more Tesla. Massive dip, made a lot of sense there. Good on you, Craig, for getting this one right. Then, suddenly, after all this execution, buy, then hold. Craig decides Tesla stock is a sell, and then all of a sudden it goes to the moon. Then Craig switches it up halfway through. You know what? It's a hold now. I was saying sell here, it's doubled, tripled, but now you should just hold. Then it triples again, even more, probably quintuples there, and here's again another hold. Now, I'm trying to understand, and I just can't. I just don't understand. Was Craig wrong when he was saying to buy Tesla stock here? I really am confused about Craig. He says one thing, he loves the company, their execution, their products, blah, they're going to sell well, they're doing great. Yet, despite that fact, despite them half a decade of doing great, the guy doesn't change his rating to, what's going on?
There are probably people that would start higher than that, quite a bit higher. But there's no sane reason for the stock to have had the valuation it had, valued at more than the total value of both the North American and European automotive sectors.
All right, time out. Now, we do need to cover a few things here, and I can understand where Craig is coming from, suggesting that Tesla's valuation got ahead of itself. I myself have said the same thing, but we do need to understand The reason that the stock market is giving Tesla such a high valuation, such a high stock price, is because the market overall believes that Tesla will continue to accelerate their lead. Their lead, in fact, is unassailable. They have a huge lead in full self-driving. They've got amazing manufacturing skills and techniques that nobody else has, and we're seeing proof of this now. They're continuing to scale their production rapidly. It's not like valuing a company. You just plug a few numbers in and it spits out exactly what that company is worth, the end, for every single company. The stock market, I believe, is giving a lot of credit to Tesla for future execution because it's blindingly obvious that they will execute, their lead is unassailable, blah, 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 blah. The same can't be said of many other companies. So in the case of Tesla, I think the market can see further out into the future and see further out with more clarity about how successful they'll be, hence their valuation is growing quite a bit. Remember, autonomy is just around the corner. When Tesla solves full self-driving, odds are the valuation of the company is going to add another $1 trillion or so overnight. Technically speaking, not exactly overnight, but you guys get what I mean. Once the market gets it and realizes Tesla's going to have these autonomous vehicles on roads and nobody else will for a couple of years, things get really ridiculous. So we're factoring in some of that future success. The second point I'd like to address is that of Craig Irwin comparing and contrasting Tesla with the total valuations of the US and European automotive markets. This would be a fair and reasonable analogy if Tesla was an automotive manufacturer. They're not. Now, they do make some products that have wheels, vehicles, they can actually transport passengers around. But the core technology inside is completely different. Never mind the other aspects of their business. At their heart, Tesla is a technology and software company. This is a really important difference. There aren't other automakers out there doing over-the-air software updates, improving performance remotely, adding new features over the air. There aren't other automotive manufacturers there who've coded their own enterprise software. There aren't other automotive manufacturers who have the world's best software engineers. There aren't other automotive manufacturers who have energy arbitrage software, moving energy from point A to point B and making money for people while they sleep. There aren't other automotive manufacturers manufacturing their own home batteries or rooftop solar. I could keep going. The point is, Tesla is not an automotive manufacturer at their core, and this is a major error, a major mistake people make in valuing Tesla. Oh, wait a minute. They're a car company. They only make 500,000 units a year. Valuation makes no sense. I don't like Tesla stock. This would be just like somebody who, let's say they're a broadband communications analyst, right? They look at Google. Some of you guys probably don't know this, but Google actually provides broadband internet to some customers in some parts of the world today. This would be like a broadband analyst looking at Google through the lens of only being a broadband company and saying, Google's valuation makes no sense. It's worth more than every other broadband and communication company on planet Earth combined. That's just crazy. This is the same error that Craig is making in terms of assessing the valuation of Tesla. He's got them boxed in. They're just an automotive manufacturer. They just make electric vehicles. That's it. Nothing special. Valuation makes no sense. This is a major mistake that so many people are making over and over and over again. One more time. Tesla is not a car company. They're not an automotive company. Yes, they do make some products that have wheels and can move passengers from point A to point B. But at their core, Tesla is a software and technology company. The end.
I don't see a lot of people stepping in, but we need to say that Tesla actually does have some levers that it is pulling this year. The entry into India, the upcoming mini car. These will have very large units, both of them. India will be just as good as China. The mini car will be more probably than the S, X, and 3 all put together. It's a very good concept for the European market, the Indian market, and I think the Asian markets as well. So, we're probably going to have to wait a while before a real buy signal in Tesla. This correction, I think, is really only partially over in the space right now.
Again, Craig Irwin making a slew of very bullish points on Tesla there. Loves the company, their product roadmap, their execution, expects sales to absolutely explode once their new vehicle, their mini vehicle, Model 2 as it's being tentatively titled by the interwebs, is actually released. Tesla India is going to be huge. Lots of positive catalysts there. Yet still stuck with a $150 price target because, Tesla's just an automotive manufacturer and therefore their valuation makes no sense.
I mean, it's easier, Craig, to say that it's crazily overvalued when it's falling, but for a long time it was just going one way up, and no matter what. And we're still a long way from your price target of $150 at $600 per share, which raises the question of what moves Tesla on a given day. Is it Bitcoin now? Is it interest rates? What do you think is actually driving this valuation?
So there's a lot of enthusiasm for a variety of things. One of those is software, which I think is a spurious argument.
A spurious argument, you say, Craig. Please tell us more about why you think Tesla's software prowess and capabilities aren't relevant to the company's valuation whatsoever.
You look at the software content in vehicles today, the nav systems in cars. Who buys those now, right? You use your iPhone, you plug it in, and you have a superior system to what the automotive OEM is offering.
Oh boy. Let me try to piece together the fragments of logic in Craig's argument there. Let's try to understand what he's suggesting. I think, based on what Craig just said, that he's implying that today, in most vehicles, the software sucks shit. Now, this is true. This is actually a bullish point towards Tesla. Also suggesting that the entirety, the sum of the value of the software abilities of an automotive manufacturer, really just some of the in-car features like navigation, just use Google Maps on your phone, it's better software. Now, Craig seems to be overlooking how incredibly important and all-encompassing the software skills are to a company like Tesla. Now, let's just start somewhere with, say, for example, the fact that Tesla currently employs the world's greatest computer vision expert, Andrej Karpathy, literally the world's best computer vision expert, works at Tesla. But yeah, you just use Google Maps. Okay, cool, right. So Tesla's Dojo, their neural networks, the full self-driving data, yeah, don't worry about that. Let's ignore the fact that Tesla's software engineering talent actually allows their factories to run faster and more optimally than many other automotive manufacturers. Let's ignore the fact that Tesla coded their own enterprise software because they had a better solution and the talent in-house to do it. Let's ignore all of that. Let's ignore the over-the-air updates, the fact that Tesla literally improves the performance of vehicles, acceleration, range, blah, 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 over the air remotely. This is insane. No one else is doing that. No one else has capability. Let's ignore all of that and just boil this down to the fact that, yeah, most software in most cars today sucks. That's kind of the point, Craig. Let's also ignore how fundamentally important software skills are in thermally managing the battery packs in Tesla. That's why Tesla today can buy the same battery cells as many other companies from LG Chem, Panasonic, etc. Do some magic, a little bit of software, a little bit of manufacturing, and suddenly get far more range on the same amount of kilowatt hours of battery pack. Yeah, let's just pretend that that doesn't matter. Let's also ignore Tesla's Autobidder software, which is performing energy arbitrage, literally making money while the owners of battery assets are asleep today. This is literally deployed software currently working today, stabilizing grids. We've got South Australia, we've got California, we've got many other examples of these big battery packs as well. Let's just ignore everything to do with that and just forget that software matters whatsoever. Good idea, Craig. You know what, Craig? I think yours is a spurious argument.
So, then you've got robo-taxis and autonomous and all these other things. People like to daydream about this. So there are some fairly aggressive technology investors that bid in and definitely aggressively buy the stock when it's going up. But those same investors are equally as aggressive on their way out. And then retail just adds fuel to the fire, right? Retail tends to drive, a lot more momentum in the space. And then the fear of missing out plays such a big role. So we've been pretty consistent saying that, it's overvalued. When something sort of gets a value of more than the total sector and only does 500,000 units versus what I think the 45 for North America and Europe combined, million units versus 500,000 units. That's absurd.
Craig,
Now, I've addressed most of these points, but I haven't really discussed Tesla's unit volumes. Last year, Tesla delivered around 500,000 vehicles. The global automotive market in terms of unit sales is close to 90 million units per year. So, if you don't do a whole lot of thinking, and you're also unaware of the concept of time, which we'll talk about in a moment, you might think, wow, Tesla, they don't deliver many cars. Why is their valuation so high? That's crazy. But that would be forgetting to factor in their compound annual rate of growth and their future projections. Tesla likely to grow at around a 50% compound annual rate of growth over the next decade, getting to around 20 million units delivered in 2030. Now, typically speaking, somebody who's investing in the stock of a company is doing so based on what they believe that company will be doing at some point in the future. So, there's that whole time thing. We look into the past, holy shit, Tesla's been growing at 40%, 100%, 40% per year. This is insane. What if that continues into the future? If we look at other automotive companies, again, using the term loosely, because as we've discussed, Tesla is much more than that. We realize that they're basically not growing. Some are in decline. Maybe they delivered 2% more vehicles this year. Maybe they delivered 1.5% less vehicles this year. Okay, They're not growing, they're in stasis, they're dead, they're flat. And then you've got Tesla growing like you would not believe. I mean, it looks like something you only ever see growing in a petri dish. That is the rate of growth that Tesla is demonstrating. This is a key reason for Tesla's valuation. Looking at Tesla's deliveries today instead of in 2025 and 2030, and then trying to understand, judge, and value the company, brain dead.
Final question. With 150 price target, the bearishness that you hold, why haven't you got a sell rating? Why have you got a neutral rating?
Because I'm a big believer that the India market is going to be fantastic. So I think Tesla has the opportunity to surprise the upside. And I believe I'm the one that broke the news of the mini car. Last year, the mini car is going to be a big deal. So the units are going to be fantastic. They're going to execute. What's going on in the stock, I don't think is really a function of whether or not Elon Musk and his team is doing a good job. It's a great company, great cars, and they're executing well. I think this is really driven by external factors as far as sort of the bond vigilantes jumping in the market and doing what they do to the equities. And then, the sector overall is one of the highest beta sectors of the market, fueled by retail. So we have negative beta on the way down. And that's really what's playing out here.
So there we have it. Tesla's most bullish bear, who has a $150 price target on Tesla stock, 75% down from where we are today, around the $600 mark. I mean, okay, whatever, Craig. Apparently, software doesn't matter whatsoever, nor does Tesla's rate of growth, but he's still extremely bullish on the company, on electric vehicles, and their product roadmap. What a contradiction. Let me know in the comments below, guys. I'm curious about your thoughts. Do you think that Craig Irwin genuinely believes that Tesla stock is a $150 stock as per his price target? Because to me, there seems to be a conflict between what he says about the company and where he believes the stock is at. I'm kind of a little bit confused. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. And don't forget, if you'd like to help out the channel and get up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a 2nd free stock valued up to $1,600. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake also using the link in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.